Welcome to Business 507, Week 5, Module 1. We're halfway through the course, and we're going to spend almost all of the rest of our time on this course talking about how to save money, defer money, or even eliminate the need to pay taxes. So let's get started. I'm sure that will get you interested, and I think you get the message here with the money we're showing you. The first one is state liquidity. State liquidity is having enough cash available for the estate to operate after death. And that's always an issue. Let's get to that. First of all, we need to take care of the family after death. I think too often people forget about the fact that the family needs cash after death. Probate, as you're familiar by now, I hope, it's going to take several years or maybe longer. So how does the family live during that period? And I'd say in most cases it's due to insurance. Insurance made out to the spouse or the family members. Second, we're concerned about the payment of debts, administrative expense, funeral, and any federal state taxes that might be incurred or will be incurred after the state tax form is filled out, and how we're going to pay for that. And I would say that as a general rule, I find that people way underestimate the amount of debts, expenses they'll have at death for several reasons. One is that the documents many times are prepared years before death, and let's face it, inflation eats up a lot over a short period of time, so that what looked like a lot of money in 1970s is not worth very much today. Another factor is that usually near death, if it's a death because of illness, you're going to have a lot of it medical cost that were not anticipated. In fact, it is said that sometimes people actually spend half their medical expenses the last 6 months of life, and that certainly isn't going to be covered by the insurance. And finally, you might have other post-mortem goals, such as setting up a foundation, giving money to a charity or a church, supporting relatives or neighbors. All of these are needs for liquidity. Might note the estate sale right away, and it's a quick sale to get liquidity for the estate, and I think you're all aware of that. If you want to buy things cheap, buy it at an estate sale. Well, why is it cheap? Because you need to get cash fast rather than maximizing the value of the assets. And so I think that one of the things that we again forget about, we have assets say worth $2 million, but if it goes through an estate sale, you're only going to get 40 cents or so on the dollar, so that's $800,000 rather than at $2 million. So I think that you always have to plan on what would be the effect of the estate sale, and maybe there are better alternatives to that, such as providing specific assets for family members. But if you need liquidity, I'll tell you, nothing gets liquidity as faster than an estate sale. It's just you don't get everything you expect. It's a major cause of shrinkage of the estate. Next chart here talks about planning for the unplanned, and people who have their estate plans generally plan on living to be the 80s and 90s, and that's true for most people today. But what happens if there's an accidental death or death from an illness that was not planned for by the testator, such as I know several people who died from the flu, and that means that in your estate plan you also have to take on not only living to being 80s or 90s, but also what happens if you die in the near future. And an example of that would be taking care of young children, just making sure you have enough life insurance available. And the recommendation is setting up a plan that reduces items subject to tax and making use of liquid assets. And that plan is what we'll be talking about later on. And IRS recognized methods to increase state liquidity. And there's 4 code sections that we cover in this course. There's others, but in this course we're going to cover 4. IRS sections 303, 2032A, 6166, and 2703, which are really designed for people who have the side businesses or own a full-time business. All of these require a significant part of the gross estate to be tied into a business interest. But if you meet those requirements, they can save you quite a bit of money and also allow for a great deal of deferral. Let's start off with the Code Section 303. It's restricted to closely held corporations. And again, the key word is corporations. And the way I put it is if your corporation is not on any exchange, such as a family corporation, and it is a corporation, that's the other part, you are eligible for 303. One of the mistakes on the CFP exam is students forget about the rule that there's got to be a corporation that we're talking about, or corporations, because sometimes it's several corporations make it up. And it allows special rules to pay for the administrative and funeral expenses as well as taxes at very attractive rates, which basically means there's no tax on the money taken out of the corporation to pay this. So if we have dividends ordinarily, or you sell a company, you're going to have taxes. You don't for purposes of the 303, which means a considerable savings to the individual. But it only covers administrative costs, funeral costs, and taxes. Those taxes could include inheritance taxes and state estate taxes, as well as the federal estate tax. The unique feature is the adjusted gross estate is modified to include all gifts within 3 years of death, and it also, I might add, has to be at least 35% of your adjusted gross estate. And so it is a very effective way to save a lot of money because you're not paying taxes on the money you're taking out of your corporation, but it is limited to, again, administrative, funeral expenses, and taxes, and that plus the fact that it's got to be corporations that people forget. 2032A is special use valuation. For those of you in California who have clients who own a business or a farm or a ranch, they call it out here, or in New York or any of the other higher priced places, this is not a significant saving. A little bit, not much, but if you live in the Great Plains, the Midwest, or the South, this could be substantial benefit for your estate. What it allows you to use the actual use and not the highest and best use for the valuation of the assets. For example, we look at Dodgers, which is the LA baseball team. They have a value, say, of, I guess, 100 million today, or 100 billion, whatever that value is. But it's not the highest and best use. The highest and best use for the land where Dodger Stadium is located is the expansion of downtown LA. Can you imagine an area that's big as a baseball field with all of the parking lot around it transferred into condominiums and office buildings? That to the IRS is the highest and best use. So when the IRS has a tax return, they're looking for the highest and best use of any real estate involved, where that may not be how it's actually used. I had a situation where a person had a 2-story office building. Next to it was a 8-story on one side, and I believe a 10 or 11-story on the other side. Well, from the standpoint of the IRS, the best use of that building would be a high-rise, and that's what would be appraised for tax purposes rather than do 2 stories. In order to qualify for the 2032A, it must be a business or farm, and the beneficiaries must continue to use the farm or business for the next 10 years. Now, you generally would find that the family members would have to sign a covenant, a contract, saying they will keep it for the next 10 years because there's penalties and interest if you don't. The real problem I've run into in my business, as well as talking to other estate planning attorneys and tax preparers, is that it's hard to get people these days to volunteer to take over a farm because it's a lot of work, or taking over their parents' business because it ties them down too much. And so many times, although the family is eligible for it, it doesn't make sense to even try it because, again, they're not going to stay with the business for the next 10 years or the farm and wind up paying penalties and interest. So why take advantage of it in the first place? If they are interested, the value of the land must exceed 25% adjusted gross estate, and the value of the land and personal property must exceed 50% of the modified adjusted gross receipt. So it can be useful. There's a cap, and the index value is $1 million. So the index value plus whatever the changes are since then. It's a nominal amount, again, for the higher cost states, but for many states, $1 million goes a long ways because it's the difference between the highest and best use and the actual use. Code section 6166 can make it very attractive, and every time I hear a politician talks about the estate tax doing away with the family farm or family business, I kind of look at myself and say, what are they talking about? Because the IRS Code section 66 allows for payment of interest and estate tax over a 14-year period for closely held business interest, and that includes farms. And the first 5 years is just paying interest on the tax associated with the business. The difficulty is the family must continue the ownership and management for the next 14 years. And again, this, like the plan we just looked at on the previous chart for special uses, requires the family members to sign a covenant, because if you don't stay there for 14 years, you've got the same situation you had in the special use. You pay penalties and interest. So 14 years becomes a requirement, and if the family is willing to do it, it's a great method. Again, this requires at least 35% of the adjusted gross estate that makes up the business interest. There's a lot more information on these in your textbook, and quite honestly, even that just barely touches the depth. This is really, if we were taking a course on this, would be a 2 or 3 day effort that we'd have to involve in. Buy-sell agreements, the entity purchase agreements in which the entity contracts with the owner to arrange for the buyout of the decedent shareholder or partner's shares, is the official definition of it. I think about the entity, that's very common use in businesses, and the big advantage of the entity use is that the owners don't have to pay anything out. The entity pays the insurance policies that are used to buy out the partners at the death or retirement of the other partners or shareholders. You've probably covered this in your insurance class. You may have even covered it in your income tax course. There's also the cross-purchase agreement wherein the shareholders or partners buy policies on each other. For me, this makes a lot more sense because you get a stepped-up basis at the death of the first party, and when you get the insurance and you pay the spouse or beneficiaries of the first to die, that value serves as an increase in your basis, where the entity has no impact on basis. So if your business over a period of time is growing in value, certainly the cross-purchase would be much better. The disadvantage of the cross-purchase is that you have to have, life insurance policies on all your partners or other shareholders. So if there's 3 partners, there's 5 or 6 policies. If there's 10 partners, there's 100 policies, whatever. And I say that this is the disadvantage for the insurance agent, not for the shareholders, because let's face it, the insurance agent is going to do a lot of work, but they're also going to make a lot of commissions. I think that the problem that I hear shareholders partners talk about, well, is I got to pay insurance policies on all my other partners. That's kind of expensive, and especially since it's not tax deductible. Well, that's the advantage being that yes, you'll get a stepped-up basis when one dies, and yes, it is an expense that is not tax deductible. The proceeds, of course, are tax deductible. Cross-purchasing agreement allows for stepped-up in basis, and that's what I said was the big advantage of the cross-purchase. Again, I like that method better because of the stepped-up in basis, but you have to look at the numbers on your clients. For example, let's say the business is currently $40 million, and the basis is probably, we'll say, $35 million, so that they only have a $5 million basis uplift, and the people are in their 50s, so the insurance policy will be quite expensive. That might change the message. So again, look at the goals of the parties. That is it for our Module 1. Get us an introduction in the area of saving money through use of business transactions. And again, I think a lot of financial planners that you've talked to and a lot of tax experts say that there are very big advantages to starting your own business.